This segment sponsored by Foster Financial. It's time for another week of Wealth Wednesday with Foster Financial, and they're going to share with us something really interesting that you need to know about end-of-year planning. And of course, joining us is our friend Caleb Doane with Foster Financial. Hello, Caleb.
Hi.
Welcome, welcome.
Thanks very much.
Yes, okay, so we're talking about a whole lot as we're ending out this year, which again, 2026 is upon us.
Right.
Can you believe it? Okay, so today we're going to talk about something that has to do with taxes, but not so much filing taxes now, but preparing for it through evaluating deductions. So what is that, evaluating deductions right now? Yeah,
so when it comes to filing your taxes, typically people have two options for the deductions. Either they can take the standard deductions, which is a flat amount, or they can itemize on their deductions. And when you itemize, that's where you kind of put together the list of things that can be itemized against.
Right,
so your donations, there would be mortgage interest in there, state and local taxes, things like that. With that itemizing section, it only applies to things that happened in calendar year 2025. And so especially if somebody is getting close to that threshold for needing to itemize, which it's roughly about $30,000 for a couple married filing jointly, about half of that if you're a single filer. But if you're getting close to that threshold, it could be a good idea sometimes to front load donations in a given year in order to push you over that threshold so that you get to write off more on your taxes. So if somebody, through their donations, state and local taxes, interest, if that had gotten them to $25,000 over the course of the year, maybe we would front load donations and put an additional $15,000 or $20,000 into a donation like a donor advised fund to push them over that threshold and then allow them to take a larger itemized deduction for 2025.
And so how does it benefit them one way or the other? Because I know the standard is like there, right? And it's already done for you. So is it worth it to do the itemization process if it's just like a couple of thousand?
Yeah, it's worth it if you're able to deduct more. So I mean, at the end of the year, the CPA is going to look at, all right, how much could you get with the standard deduction? How much could you get with the itemized? And just give you whichever one is more advantageous. The maybe opportunity missed that we see with a lot of clients is if they're getting really close to being able to itemize every single year, but it's not really over that threshold. So maybe they're donating, $20,000 a year, and they're donating quite a bit, but it's just not enough to itemize. Instead of doing that, maybe we front load the donations where we donate $60,000 in 1 year, and then we don't donate for the next 2 years. And so we take a really big itemized deduction that year, and then the next 2 years we just take the standard deduction. And maybe a pushback that we would get is, well, I don't want to donate $60,000 to my church all in 1 year and then nothing for the next 2 years. So that's where we use a donor advised fund, where we put that money into the donor advised fund all in 1 year. When the year that you put the money into it, it counts as a donation. And then you can give the normal $20,000 per year to your church for the next 3 years. So it's basically just front loading those donations, so then you get a larger itemized deduction and then can take the standard deduction in future years.
With the donor advised fund, is this something that is typical for people to utilize outside of just wanting to evaluate their deductions? Is this a normal account that they can use throughout the year?
It's certainly something that's gaining a lot more traction. I'd say just the more that people are getting interested in saving money for retirement and optimizing their taxes and making sure their financial life is in order. So it's certainly something that we've used at our office for a long time. But even if people aren't necessarily using it for the tax benefits, it can, donor advised fund can just be a good way to organize a lot of your donations so that it's one place that you're donating to, and then from there you're making distributions to the different charities. Another big benefit of the donor advised fund is that once money is in the donor advised fund, it can be invested in the stock market, and any gains in that account is completely tax free. And so that's another added benefit that we like to use for clients too.
Okay, so any gains is tax free. You put it in without paying taxes, right? That's just a part of your income?
It's usually after tax money that you're putting into the account,
Okay, and you say a benefit is that you can include it in your stock purchasing. So is there a max that someone can put into this DAF?
Yeah. So the max amount that you can itemize on your taxes for stock donations, because you can donate stock into a donor advised fund and actually avoid capital gains on it. It's about 30% of your adjusted gross income that you're allowed to donate. About 60% of your adjusted gross income you can donate in cash into the donor advised fund. So there's different thresholds depending on what type of assets you're moving into the donor advised fund. But we always kind of customize that for the client. We know what their adjusted gross income is, how much we're putting in, and we can make sure it's optimized for them.
Okay, perfect. Thank you so much, Caleb.
Yeah, thank you.
And if you would like more information about Foster Financial, we'll have their website and their phone number listed below. Give them a call to help you keep going with your end of year planning, and I'll see you after the break. This segment sponsored by Foster Financial.